Hi there, welcome to Kneppy Invest. There are a plethora of drilling companies on the ASX, including the company I'll be featuring in today's video, DDH1 Drilling. It's actually in the name. And I have been looking at this company closely over the past few weeks just based off the chart. So when we talk about drilling companies on the ASX, I can name just three right off the bat. Bort Longyear, which has done horribly over the last few years. DDB, which is Dynamic Drill and Blast. Ausdrill, which then became Parenti. They diversified. Mitchell Services as well. And I think because there are a lot of companies, not only on the ASX, but also private companies in this space, that means it's fairly fragmented and ripe for consolidation, ripe for mergers and acquisitions. And in fact, DD1 Drilling has gone down that route over the past few years. And we'll talk about that during this video. Now, you do have to be aware in this space because back in 2016, with the mining boom over, there was much less spending in drilling. And so a lot of ASX drilling companies did suffer. Have a look at the Bort Longyear chart. This company was overburdened with debt, might be even still overburdened with debt, and even with a consolidation of the share price, to get rid of a lot of that debt, they had to issue a lot of shares. So even if you look at a chart, go back to 2016-15, it says the share price was over $1,000. That's because of the amount of shares issued and the share consolidation. So Bort Longyear hasn't really recovered from 2016. Ausdrill, which did come Parenti, PRN, had a major downturn in their share price, something like 25 cents. We also saw at least one company go bankrupt during 2016. So this is a fairly cyclical sector, and you do have to be wary and acknowledge that if you are investing in these companies. I don't think drilling companies or mining services companies, even mining companies, are the sort of companies you buy and own for the long term. DD1H Drilling has its history go all the way back to 2005, when one of the businesses it acquired was established by Matt Isaac, and then DDH1 Drilling was established by Murray Pollock and Matt Thurston in 2006. So an interesting history here. You can find this particular slide within their prospectus, because this company listed on the ASX about 2 years ago or something like that. And I actually did go to their prospectus and have a look. And the prospectus not only provide a lot of information about the company, but also a lot of information about drilling. It was actually quite fascinating. And a nice little history here. Not only do they give a history about the acquisitions this company has made, and drilling, or DDH1 Drilling, has acquired quite a few businesses, I think at least 3, maybe 4, including that Ranger Drilling in April 2019, Strike Drilling in 2018, and they've also made an acquisition post-IPO of Swick. We'll talk about that also. And on the bottom here, just mentions that DDH1 drills the deepest mineral core hole in Australian history at Northern Stars Resources Jundee Gold Mine. That was in 2018. And in 2019, they completed the deepest mine service hole in the Southern Hemisphere. So just based off those two little tidbits of, interesting information, maybe not that useful, you probably could argue that this company is quite experienced and quite knowledgeable about how to drill. And that does fill me with a little bit of, what's the opposite of wariness? A little bit of, not hope, a little bit of, well, I'll just acknowledge that this company knows what they're doing. Where does DDH1 Drilling stand right now? So we have DDH1 Drilling, the original business, with quite a few rigs, and they have acquired Strike Drilling, Ranger Drilling, that was pre-IPO, and then post-IPO Swick. And what Swick did was increase their global reach. So the other businesses seem to be primarily in Australia. So it says DD1H Drilling, Australia-wide operations, Strike Drilling, Australian-wide, Ranger Drilling, West Australia-based operations, while Swick was based in Australia, Spain, North America, and Portugal. And what a lot of these businesses also provide is drilling through all stages of the mine cycle. So the mine cycle is quite long, starts with the exploration and then ends with the end of mine life. So they have to do stuff like regeneration and that sort of thing. So let's see if they do have drills that are useful throughout the whole mine life. And in this particular slide, I forget where exactly I found this, they show you those different periods of the mine cycle, life cycle. So you have exploration, development, production, and the last cycle is when the mine loses all its stuff, and they have to spend money to regenerate the environment, that sort of thing. So of course, there is no need for any drilling in that part of the mine life cycle. But during the exploration, a little bit of drilling, but definitely during the development and production, a lot of drilling. Now, through the mine construction, which might take 2 to 5 years, a little bit less drilling through that, but definitely through the pre-feasibility, feasibility study, and then the life of mine extension, which can take numerous years, a lot of drilling. And they also provide you which companies have services or provide drilling services during that life cycle. So DD1H drilling is through the whole period, Ranger drilling through the whole life cycle, Dryx drilling through the exploration and development, not through the production, while SWIC mining services is primarily through the production mine life cycle. I was very tempted to mention the amount of rigs each of these businesses have 2 slides back, but then I remembered that I did provide this particular slide just showing you the amount of rigs. Now, the acquisition of SWIC did significantly increase the amount of drilling rigs they have, because DDH1 have 75 rigs, Ranger drilling 22, Strike drilling only 14, but SWIC have 73 rigs. So that was a very useful acquisition in terms of increasing their rigs, not quite by 100%, but definitely 100%, yeah. But not quite by 100%, maybe by 75% or something like that, because Ranger drilling and Strike did have about 36 drills combined. So they have been increasing their rigs through the last 10 years from 84 to 183. I think some of that is the rigs that those acquisitions they have made had before they acquired those companies. So you don't see a massive jump in these figures when they made the acquisition of SWIC. Now on to the CEO of DDH1 Drilling, and the CEO is Sy van Dyk. Pretty sure he's South African. He was the CEO and CFO of McMahon Holdings, which is another mining services company. I wouldn't say that is a highly successful mining company, but he has extensive experience. He says here about 30 years experience, primarily within the resources sector. He also held a number of senior positions within the Kimberley-Clark area of South Africa. He became the CEO of DDH1 Drilling in 2018, October of that year, and a managing director in February 2021. Now to the shareholders of this company, and some interesting names here. So DD1H1 Drilling or Holdings Singapore has the largest stake with 18.5%. Murray Pollock, the founder of DDH1 Drilling, has 11.6%, totaling about $28.7 million. We also have Tribeca Investments, Wilson Asset Management, WH Soul Patterson, they have 3.42%, or which totals about $8.5 million US. Sprott Asset Management, Fire Trails Investments, so quite a few fund managers that I have heard about here. And the CEO, Sy van Dyk, has 1.21%, $3 million US total. And Kent Swick, which is, I think, the founder of Swick Drilling, has 0.63% or $1.6 million in DDH1 Drilling, and more than likely that holding is because of the acquisition. And then right at the bottom, we have the Florida State Board of Administration. So we do have a fairly large pension fund, American pension fund, have a little bit of stake within DDH1 Drilling, only $700,000, but still it's interesting to know that a United States pension fund, a fairly big one of that, has a stake in this company. Now to some facts in regards to this company. I'm going to try stop saying the company's name because I'm going to get it wrong. I'm going to keep saying DD1H Drilling. So I'll just call DD1H Drilling this company from now on. Now, the amount of shares this company has is $410 million. You notice that little star I have there, and the reason I have that star is because this company is going through a share buyback right now. So the number of shares is dwindling fairly slowly downwards, because the best reason a company would undergo a share buyback is if management think the shares are cheap. Now, I have seen on occasion companies go through a share buyback when I probably would argue the shares of that company are overvalued, and I think that does not provide value to shareholders if companies do that sort of share buyback. Anyway, so shares on issue right now about or just over $400 million. That means a markup of this company at 88 cents is $363 million. And this company is not only profitable, they're also operating cash flow, free cash flow positive. So they do provide a dividend to their shareholders, and that dividend yield is 5.1%. So that's quite nice, particularly because the company is growing, and it's growing at a quite nice rate. Total equity, 342 million. The reason I look at total equity is if I see total equity or the market cap gets significantly below the total equity, I might argue that is a representation or possible representation of pretty good value. But at this point in time, the price to book of DDH1 Drilling, or this company, is actually over 1. So you want that price to book if you are arguing that to be significantly lower than 1. And the ticker of this company could be anything else than DDH. Now onto the financial year 22 numbers for DDH1 Drilling, or I should say this company. Nice growth in revenue. So those grey numbers in brackets is financial year 21 numbers. Financial year 22 numbers is in the blue here, and revenue grew from 295 million to 415 million, helped by the acquisition of Swick, I'd probably assume. Operating cash flow increasing from 46 million to 81 million. Free cash flow, because this company does spend or did spend a fair bit of money over the past 2 years on capital expenditure, only $15.5 million of free cash flow. Now look at profit. Profit actually fell from 57 million to 36 million. Now, if you just looked at profit in isolation, you'd probably be horrified that profit fell by a fair bit. And there is a reason behind that, and I'll discuss that reason later in the video. Net debt of about $12 million. PE ratio not too stretched, but that's based off earnings, not cash flow, 10.1. If you look at enterprise value to free cash flow, significantly higher at 24.2. So if I looked at that sort of valuation metric, I wouldn't say that this company is undervalued right now. And I've already mentioned that price to book ratio is just above 1, sitting at around 1.1. Since this company did list on the ASX a few years ago, we don't have a lot of history here. So 5 years of history, going back to 2018, and revenue has grown quite nicely. In fact, it's increased from 125 million to 415 million. No doubt a lot of that increase in revenue is because of a few acquisitions. So I would like to know how much of the growth in revenue is because of organic ways and not because of acquisitions. So that would be probably something I would want to know as I dig a little bit deeper into this company. And when you look at operating margins, it was actually increasing from 2018 to 2021, increasing from 15% to 16%. But in the past year, that fell by 3% down to 13%. That's not indicative of anything wrong with the business, because maybe in 2023 we will see operating margins increase, but that could be because of that acquisition of Swick. Maybe Swick margins are significantly lower than the rest of this company. Now on to why the profit for this company fell a fair bit from last year to this year. So this is the P&L statement from the company's annual report or whatever. And the main thing I'm looking for here is, I don't care about revenue because we already know revenue increase, but I'm looking at EBITDA, EBIT, and then profit. So if you look at EBITDA and EBIT, both of those increased significantly from last year to this year. So EBITDA increased from 65 million to 90.8 million. So what is EBITDA? That's earnings before interest, tax, depreciation, amortization. So then you go from EBITDA to EBIT, which takes out or brings in those depreciation amortization. And this company did have quite a bit of depreciation expense, almost $30 million in 2022. But that's not the reason, because EBIT for this company increased from 42 million to 55 million. So what's the difference between EBIT and profit? Well, it's interest and tax. And this company didn't receive or spend a lot of money on interest. So the reasons why this company's profit fell significantly from last year to this year was all about the treatment of tax. So last year, they actually had an income tax benefit of 17.8 million. And that income tax benefit became expense in this year of 17.5 million. So this is a very important reason why you just don't look at profit for a company and then judge the performance of that company just based off that one number to last year's number. Now onto the cash flow statement, and some of the things I look for in the cash flow statement include the receipts for customers, the operating cash flow, and we know the operating cash flow is about 84 million. So this company in their operations is generating a lot of cash. But I probably would assume that a lot of these drilling companies have a fairly high capital expenditure. And capital expenditure is the payments for property, plant and equipment in the cash flows from investing activities. And in 2022, this company spent $65 million on capital expenditure. Last year, they spent $39 million. So to get the free cash flow, you take the operating cash flow and decrease the capital expenditure. Now, what I also do is decrease principal payments for lease liabilities. In my opinion, that belongs in the operating activities. Now, there was an accounting change a few years ago, but that's just my opinion. So when I look at operating cash flow and free cash flow, also take away the lease liabilities. And that's why there is a little bit of a difference between what the company reports in terms of their operating cash flow, free cash flow, and what I report. But overall, cash on hand actually did increase during the year for this company. Even though they spent a lot of money on capital expenditure, they also paid a dividend, so $17.7 million in dividends. Cash on hand still increased by $3.2 million. That was also helped by cash acquired on business combination. So if you take that away, in fact, cash would have fallen from the year. So you do have to take that into account as well. The company has provided a bit of an update recently, and this is the first quarter of financial year 23, and things are still moving in the right direction for this company. Revenue up 16.7%. So they're comparing the first quarter of 2023 to the first quarter of 2022. That is the way to do these comparisons. So like for like. Anyway, EBITDA up 9.5%. Revenue per shift up 4.3%. Rig count up from 169 to 185. Rig utilization. This is a very important point that I haven't mentioned in this video. It's important to have a lot of rigs, but it's most important to be using those rigs. So you want a high number when it comes to rig utilization. So at 80.9%, a slight increase from 1 year ago. There is room for improvement for this company. Average number of shifts increasing from just under 25,000 to just over 25,000. Now to the only chart I have for this company, going back to when they listed on the ASX, and that's they listed at the start of 2021, so almost 2 years on the ASX. There was actually some nice sentiment in this company from when they listed all the way through to the end of 2021. Share price actually rallied from about 85 cents to a high of $1.30. But the share price then moved into a downtrend during the start of 2022, and the share price sort of fell off a cliff in May and June, decreasing from about $1.10 all the way down to a low of 63 cents, which was in June. That was the bottom of the Australian market at this point in time, and the share price has rallied nicely, and it does look like it wants to move into an uptrend. The recent highs we saw about a month ago were just above 93 cents. So the share price gets above those levels, that would be a new high and some more confirmation that the share price is moving into an uptrend. So a shift in sentiment. Looks like the share price is trying to move in an uptrend. So things are looking good for this company. Just based off the chart, things are also looking good when you look at the business. But again, be wary that this is a cyclical company. All these drilling companies are cyclical. If there's a major downturn in mining, so if commodities absolutely fall away, these companies can be highly affected by that downturn. Anyway, that's my first look at DDH1 Drilling. If you have any questions about this company, maybe you have more insight into this business, so leave your thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.